Hello everyone, it's Davide here and welcome back to Learning Finance. So in today's video guys, I'm going to try to answer a question which I think that a lot of people are asking right now, and sometimes I've asked this question to myself too. The question is pretty simple. Does it make sense to continue to buy stocks at that level, or should we wait for a retracement or a market crash? I'm gonna try to explain what do I think about that. Obviously it is my opinion. What am I gonna do? So what is my strategy? So we are gonna see all of that. The only thing I ask you guys is please leave me an early like. It's very important and I thank you for it, and subscribe to the channel so you don't miss any new updates. Let's begin. So guys, here we have the S&P since March, basically the dip in the middle of the pandemic. The S&P went up at the moment 73%. Incredible return, but what do we have to expect right now? So the first main question, will a stock market crash happen in 2021? Okay, so this is the question that a lot of people are asking themselves, and it is pretty normal to ask this. Now, I don't know if you have seen this movie, which is The Big Short. That's a wonderful movie, one of my favorite in terms of financial movies. We have Christian Bale interpreting Michael Burry, which, if you don't know, is the man that actually predicted the 2008 financial crisis and made a lot of money from it. However, how easy it is to predict a market crash? We have seen incredible investors, okay, like people like Peter Lynch, Warren Buffett, basically the top personalities in the investment business, came out in public and said no one can predict the stock market. So what do we know in terms of statistics is that usually a stock market crash happens at once in a decade. Every 8 or 10 years, we have a market crash. We have just had the fastest crash in the history. Okay, never happened before. It was the most violent crash in the history in March. Statistically, we have already had a market crash last year. Okay, so how likely? Because here we have to analyze in terms of likelihood and not in terms of predicting the stuff, which is impossible. Okay, so will a market crash happen in 2021? 100% honest answer, I have absolutely no idea. Let's try to do it with likelihood. Is it likely that the stock market will crash again in 2021? In my opinion, no. Okay, it is not likely. Can we have a correction like a minus 15, minus 17%? Well, yes, that's absolutely possible. So should we wait for this, let's say, call it correction to buy stocks? Well, to answer that question, we have to actually see something different over there, okay? Because we have to analyze what is the alternative. Now, this is the JP Morgan Market Insights, which is a document that they release. This is the outlook for 2021. Now, before we take a look at that, we have to understand one thing. This is if you are a long-term investor, okay? If you have some money that you don't need, this is important, it is key. If you have some money that you want to invest, but you know that you're gonna need those money in like 5 months time, then do not put any money in the stock market. Okay, this is my best advice. Do whatever you want, but do not put any money in the stock market if you need those money. The investment, it is a long-term investment. Okay, so money that you don't need, but you don't want to keep cash, because as we know, cash, it is not a wise move to do, especially after a pandemic where 23% of existing money has been printed, okay, in a single year. So what is one of the main assumptions that I see in different videos or people talking about blogs and articles is that the stock market should pull back a lot because it is overvalued, okay, in terms of a PE ratio. See that this is November 2020, average PE ratio in the S&P was 21.80. As we can see from here, the 25-year average has been 16.54. Then the Schiller's P ratio averaged 27.45. It is almost 33. The dividends are obviously lower because prices are up. So as you know, it is a percentage of the price. Then also the price to cash flows, almost 50% higher than that, but doesn't mean that the stock market has to crash. And why is that? Because this ratio, it is simple, okay? P ratio, price divided by earnings. So there are two ways for this to come back at a sort of an average. The first one, the price that drops. What I expect, which is completely different, is this. What I expect, and what also JP Morgan is expecting, is not a market crash. It is earnings that will push back higher in 2021 once this pandemic has gone, which they are expecting the pandemic to be gone completely at the end of the summer. And what happens when you reopen the economy where things continue to be hopefully as they were before, is that earnings, which has been contracted like crazy during 2020, they will continue to go higher. Okay, businesses, they will start to do well again, especially things that are related to the real economy, in order that the average earnings of the companies in the stock market, and especially in the S&P, will go higher. And even if the prices remains the same or continue to increase a little bit, this ratio over there will come down. Okay, it is a ratio. If you increase the denominator, that number should decrease. So to push it back, we don't need a market crash. That's an important thing. Plus, here we have to try to understand what are the alternatives. So usually the main alternatives, if you want to invest money or you open a business, so this is your thing. It is not easy to do. If you do it, good luck. But then in terms of investments, you have bonds, you have real estates, okay? Those are the main ones. Then you have obviously commodities, which can be interesting, okay, going on in the future. However, those are the alternatives, and especially bonds and deposits. Those things are, in my opinion, out of the equation, simply because, as we can see, the interest rate, it is extremely low, absolutely to zero. And do not forget that the Fed is still pushing every single month $120 billion, okay, in the economy. This thing added with an interest yield at zero, so that in the bank you don't get nothing. If you buy bonds, you don't get nothing, or you get negative interest yield. Plus, we have to consider, because we have to do it, the inflation. Inflation, which is now around 1.5, but if we take a look at the JP Morgan's estimates here, we are gonna have the inflation above 2% by basically this spring, touching about 2.5% for basically an entire year. What is their explanation of that, which it makes completely sense, is that inflation should recover in line with the economy, okay? Wage growth should be slow over the next few months, but then accelerate in the second half of 2022. This is the key. This, combined with a shortage of airline seats, hotel beds, restaurant tables, and eventually apartments to rent, could push inflation, as measured by the consumption deflator, above 2% in the second half of 2021 and keep it there until 2022. Now, this is very interesting because if you remember, for example, airlines, they had cut a lot of flights, they sold a lot of planes, and a lot of the flights that were used to be there before the pandemic, now you're not going to find them anymore. So less flights, a lot of restaurants and stuff has completely went bankrupt. Okay, so they closed. They don't exist anymore. So less restaurants, as well as hotels, the minor hotels, like a lot of them went bankrupt. Once again, you have less places. So when you're going to reopen the economy, probably you will have a huge demand because people have been stuck in their home for more than 1 year. But on the other side, the supply is actually lower. Okay, it is simply lower because a lot of those things, they have been cut because to cut costs, or they went bankrupt, okay, directly. They're not there anymore. Because of that, prices are very likely to go higher. Less supply, more demand. That's pure economics. So that's what they are saying here. And that can push the inflation above 2% until 2022, where basically the firms will actually be able to adapt, develop, and then meet the demand so that things will come back to normal. But that means that if in this year you keep your cash, well, this is what you're gonna lose. Almost, considering their projections, you're gonna lose around 2.5%. There are very moments even above that. And this is not absolutely something that you want to do if you have cash aside that you don't need. So as you can see, there is not a very big alternative to stocks and real estate, okay? Because you can buy real estate, but obviously it is not a liquid investment, and not everyone can afford it because it is a big expenses. Now with the pandemic, not everyone can get a loan, not everyone can buy real estate. It is not something easy to do. Probably it is easier to buy some stocks. Now bonds, no one wants bonds. No one wants the cash to keep there in the deposit in the bank because it loses value. Where is the alternative to stocks? I don't know, probably commodities, but once again, there is no a big alternative to that. And people are, I don't know if you have seen the interview there. Now he's a big private equity investor, okay, and he was talking about Tesla stock. He was saying, well, are you planning to sell Tesla now? And he was like, no, why should I? I am owning an asset which keeps value and increases in value. Why? Otherwise I should have cash. And to have cash, I should pay taxes and then have a lot of cash there, which basically loses value. So to have a market crash, we should have a lot of people selling stocks. But considering these assumptions, is it something wise to do, to sell good businesses or not? So in my opinion, no. And it's why it is very unlikely that we are gonna see a market crash. As we can see from here, they are saying that returns on cash are low and are expected to stay that way. Okay, so they don't expect the interest yield to go higher in the short term. Why is that? First of all, in my opinion, that's just my opinion and not JP Morgan's opinion, I don't know, but in my opinion, our system, it is made in a way that it is not possible after a while to push the interest yield higher. Simply because our system works with debt. If you see the debt levels during the last 30 years in the United States, they only went in one single direction, which is up. Now, when that happens, when you build an economy on a lot of debt, but this is not just US, you have Europe, is exactly the same. I'm from Italy, exactly the same, okay, even worse than that. What happens? It's pretty simple. If they increase the interest yield, it's like they shoot themselves. Okay, if you increase after the pandemic, let's say the Fed is gonna say, well, we will increase the interest yield. Guess what is gonna happen? Everything will collapse. There are businesses that they survived with a lot of debt. If you push the interest yield higher, it's gonna be a disaster. This is basically the reason why the trend since 1980s, 2020, 40 years, always a downtrend. Always. And now I think that I expect the interest yield to not increase much over the next 5 years. With that being said, it is in agreement with what they say over there. Returns on cash are low and are expected to stay that way. So once again, do we have an alternative to the stock market that we say, oh, that thing is better? Well, no. That's the short answer. No, in my opinion, no. And in terms of these price to earnings ratios that a lot of people are paying attention to, well, it can go down without a crash. So now let's answer the main question here. Does it make sense to continue to buy stocks? Well, in my opinion, if you have cash that you don't want to use it because you don't need it and you want to invest it long term, well, absolutely yes. It makes a lot of sense. And obviously, if you think about the long term, you have probably already bought stocks, so you have an average cost per basis which is lower than now. So if you continue to buy stocks, you are averaging. On the long term, this is, in my opinion, a great strategy to do. Obviously, you should buy firms that you think that are quality investments. Okay, so firms that they make money or they are quite unique, they have a lot of growth ahead, and also in terms of profitability, they are set to be great. Okay, so quality firms. You can take a part of your portfolio and go on with more speculative stocks. That's perfectly fine. I do it. I am invested in Lemonade. It is something I believe, even though in terms of margins right now, it doesn't make absolutely any sense, okay, as an investment. Does it make sense to continue to buy stocks now? Yes, absolutely yes. Quality stocks, okay? Even high growth stocks, but they are quality. Okay, so you can see the scalability, you can see the moat, you can see why they are unique, you can see the growth prospects and increase in profitabilities over the year. That's perfect. But penny stocks, this kind of stuff, just pure speculation, guys. In my opinion, it is like going to the casino, okay? Las Vegas or Monte Carlo. That's exactly the same. A lot of those companies are actually selling dreams and not actually doing the things. So there is only expectation. You are buying extreme high multiples because of expectations. Well, do you think that all of those expectations are gonna be met in the future? Well, my guess, no, absolutely not. So this is the end of the video, guys. I hope you find it interesting. Leave me a like and leave me a comment below. Tell me what do you think about it. Subscribe to the channel, and as always, guys, have a wonderful day.